Hello everybody, I just received my Keppel REIT units as a dividend in Specie and I decided to sell everything. So in this video, let's talk about why I did what I did and the rationale behind it. So the last thing that I did for Keppel REIT was to sell a big portion of my holdings at 89 cents in August. So this time around, I sold the dividend in Specie units at 80.5 cents. So that's like 10% lower than what I last sold, right? Which is quite a pain in the ass. I didn't really want to do it, but after considering everything, I made a rational decision to sell the stuff. After all, I got this stuff for free. I didn't pay a single cent for it. It's given to me by Keppel Corp, so I didn't think it's a good decision to hold it. If things are calm, then I might have held on, but things are so rough and everything was sold off everywhere. I think I got better opportunities elsewhere. So I deployed the capital into REIT at 34 cents, which have tumbled massively since the rights issue at above 40 cents, right? This stuff has just been relentless sell-off, and I think this sell-off was not uh, uh, correct. In fact, I think at these valuations, this is giving extremely good value. So I just decided to rotate the stuff from here to here. Of course, it sucks to be selling Keppel REIT at this kind of price, right? Normally, when a share price hits this kind of 5-year lows and stuff, you should be looking to buy instead of sell. But in this case, I decided to sell. I talked about my bearish sentiments on Keppel REIT in my last video. That's a few months earlier. I've not changed my view. In fact, even more bearish. So let us talk about two reasons why. The first reason is the supply-demand dynamic for office properties in Singapore. In last year, I was bullish on Keppel REIT actually because of the rental dynamics, which was quite positive. But coming to the next 2 years, you can see that there's a bit of a supply coming up, right, in 2024 and beyond, especially this 2024 supply, right, which is quite massive. IOI is going to be up, and then Keppel South is going to be up, North Bridge Road is going to be up, and subsequently you can see in the Bugis area, Shaw Tower is going to be up, and so on and so forth. So I think all this stuff is just gonna add to supply. So the bullish sentiments around the leasing for offices in Singapore is a bit softer, I think. And given that I'm still quite bearish on the economy, I think there's gonna be a recession. I think the Fed is completely wrong because they are thinking that there will be a no landing or soft landing. I think they're completely wrong. I think there's gonna be a pretty decent recession. It's gonna hit Asia especially hard if the China slow down. And look at Australia, it's not good either. Look at the occupancy rate. In general, it's not a flat line. It's trending downwards, right? See, this stuff is trending downwards, kind of established, but nonetheless, it's still trending downwards, right? The trend is not in the favor of Australia office dynamics as well, except for maybe Perth. But I think Perth is a matter of things bottoming out over here and just coming back slowly into life. But nonetheless, even if this stuff is slowly trending up, occupancy rate is just 80+%, right? Which is nothing to be overly excited about. So I think the demand supply dynamic for offices in Singapore and Australia is not massively bad, but it's nothing to be overly excited about either. So on the macro side of rental reversions, I'm less bullish about this stuff already. I think the second most important thing is just the profile of the balance sheet. If you look at the debt maturity profile, in 2024, 22% is going to be refied, and then another 21% is going to be refied. And given that the weighted average term to maturity is just 2.7 years, I think the Fed is going to be higher for longer. And more importantly, I think the terminal rate for the Fed funds rate, even if they start to cut, it's going to stay elevated. I don't think it's going back to 1 to 2%. I think it's going to be like a mere 2.8 to 3.2%. That's the terminal rate, I think. So it's going to be like that, and then cut, and then it's going to be like that. Whereas previously, people were thinking it would be like that, and then cut, and then it will be like that. So I think the market is wrong. I think the terminal rate will be higher. And if a terminal rate is going to be at 3+%, that will spell a lot of trouble for this REIT. Because if currently the financing cost is 2.85%, and you raise the financing cost to more than 3%, something not very pleasant is going to happen. And that is due to the cap rate. Look at the cap rate of the office assets that they have in Singapore. The cap rate is just 3+%, right? So if you hold office assets that yields you a yield of 3+%, and your funding cost jumps up to more than 3+%, then there's a negative yield spread. So I don't think this is very positive for what's happening. If you look at the Australian cap rates, it's better. It's maybe 5%, to 5.5%. So you have something below and something above, right? But on average, it's around 5 to 5.5%, right? Which is higher, so you get a better yield spread. But nonetheless, given that the majority of the assets is still in Singapore, I think I don't like the profile of the balance sheet anymore, because the yield on the assets they have is way too low compared to the yields they have to pay on the interest cost. So these are two main reasons why I'm not bullish on Keppel REIT anymore, and decided that given that there are better opportunities elsewhere, I just decided to sell everything and move on.